What if I told you the marketplace that decides the global price of silver is quietly running out of actual silver? Not slowing down, not stabilizing, running out. The numbers aren't rumors, opinions, or social media hype. They're pulled straight from official warehouse reports. In just a few months, over 100 million ounces have disappeared from deliverable inventories. Contracts are stacking up, delivery requests are rising, and the math suggests a breaking point is dangerously close. This isn't drama, this is arithmetic. And if the trend continues, the consequences won't stay inside trading screens, they'll spill into the real world. Let's begin with the core issue, the difference between paper silver and physical silver. On futures exchanges like COMEX, traders buy and sell contracts representing silver. Each contract equals 5,000 ounces. Most traders never intend to touch real metal. They trade price movements, numbers on screens. When contracts near expiration, they roll them forward into a later month instead of taking delivery. Under normal conditions, only a small percentage of contracts demand physical silver. The system was designed that way. The exchange vaults hold a buffer, enough metal to satisfy routine delivery, not a global rush. But something has changed. Warehouse data shows that registered silver, meaning metal officially available for delivery, has dropped sharply over recent months. The decline isn't flat or random, it's accelerating. Tens of millions of ounces have left the deliverable category month after month. To put that into perspective, global silver mine production averages roughly 800 plus million ounces annually. That means around 65-70 million ounces per month come out of the ground worldwide. Yet the exchange has been losing a significant percentage of that monthly output from its vaults consistently. Now here's where the tension builds. Delivery rates have surged. In what is normally a routine expiration cycle, an unusually high percentage of contract holders are choosing to stand for delivery instead of rolling forward. That signals something critical. Participants want metal, not paper promises. At the same time, futures contracts that should be smoothly rolling into later months are moving slower than expected. That creates a pileup. If too many contracts remain open into expiration, vault inventories must satisfy those demands, and the vault is shrinking. There's also an international dynamic. When price differences open between exchanges in the West and markets like Shanghai Gold Exchange, physical metal can flow toward the higher price. Silver moves where premiums are strongest. Once it leaves, it doesn't automatically return. So the problem isn't one isolated number, it hangs a chain reaction. Declining registered inventory, rising delivery demand, slower contract roll, global arbitrage pressure, growing distrust of paper settlement. Individually, each factor might be manageable. Together, they form structural stress inside the pricing system itself. Now, here's the part that shifts this from concerning to potentially historic. While vault inventories have been falling, major silver mining companies have been reporting earnings, and their realized selling prices tell a story that doesn't match the futures screen. Two large producers, operating in different countries under different regulatory frameworks, reported that the average price they actually received for their silver was dramatically higher than the benchmark futures price during the same period. Not a small difference. A premium of over 20%. Let that sink in. If the futures market says silver averaged in the mid-50s, but miners are consistently receiving prices closer to $70 per ounce, something is misaligned. In a perfectly functioning system, arbitrage should eliminate that gap. Buyers would simply purchase futures contracts, take delivery, and pay the lower exchange price. But that's not what's happening. Industrial buyers, the manufacturers who require silver for electronics, solar panels, medical equipment, and defense applications, appear willing to pay more for guaranteed supply directly from producers. Why? Because certainty matters more than theory. If you are running a factory that depends on silver inputs, a delayed shipment isn't an inconvenience, it's a shutdown. So companies are increasingly negotiating direct supply agreements instead of relying solely on exchange delivery. This shifts metal away from public inventory channels and into private pipelines. And while all of this unfolds, policy discussions have emerged in Washington about creating structured pricing mechanisms or strategic reserves for critical minerals, including silver. Officials have openly stated that sustainable pricing is essential to unlock long-term investment in mining and refining capacity. When governments begin discussing price floors for industrial metals, it signals recognition of supply strain. So now step back and connect the threads. Exchange inventories declining, physical demand rising, delivery rates unusually high, futures roll slowing, miners receiving premiums, industrial buyers bypassing exchanges, policymakers talking about structured pricing. Each of these alone might be dismissed. Together, they suggest the physical silver market is tightening faster than the paper market can adjust. And that leads to the bigger question. What happens if the pricing mechanism can keep up with physical reality? To truly understand what is unfolding in the silver market, You have to step back and look at how the modern pricing system was built in the first place. The global benchmark for silver pricing is largely determined through futures trading on exchanges like COMEX. Futures markets were originally designed as risk management tools. A mining company could lock in a selling price months in advance. A manufacturer could secure supply at predictable costs. Speculators added liquidity, making it easier for both sides to hedge. The system worked smoothly for decades because most contracts never resulted in physical delivery. Traders were exchanging exposure to price, not bars of silver. As long as only a small percentage of participants requested actual metal, warehouse inventories could comfortably support the system. But over time, something changed. The volume of paper silver contracts expanded dramatically. On many occasions, the total ounces represented in open contracts far exceeded the amount of silver sitting in exchange vaults. That imbalance wasn't seen as a flaw because behavior remained predictable. Most traders rolled their contracts forward before expiration. The exchange became less of a physical marketplace and more of a financial arena. Then, global demand patterns began shifting. Silver is not just a precious metal. It is a critical industrial material. It is essential in solar panels, electric vehicles, 5G infrastructure, semiconductors, medical equipment, and advanced military electronics. As the world accelerated toward electrification and renewable energy, silver demand quietly strengthened. At the same time, mining supply did not expand at the same pace. Bringing a new silver mine into production is not like opening a retail store. It requires geological exploration, environmental approvals, infrastructure development, financing, and years of construction. The timeline can stretch 7 to 10 years. That makes supply relatively slow to respond to sudden increases in demand. When demand rises faster than supply, pressure builds beneath the surface. Now add another layer: investor psychology. During periods of inflation, currency uncertainty, or geopolitical tension, precious metals often attract investor interest. Silver, being both industrial and monetary in character, can experience amplified moves. When prices begin rising sharply, confidence in paper claims can weaken. Market participants start asking a simple question: if I hold a contract, can I actually get the metal? That question changes behavior. Instead of rolling contracts forward, more traders may stand for delivery. Instead of viewing futures as purely financial instruments, they treat them as allocation tickets for real inventory. This behavioral shift appears to have emerged recently. Delivery percentages have climbed well above historical norms. Vault withdrawals have accelerated. Registered inventory, the category of silver immediately available for delivery, has declined month after month. The decline itself is not the only concern. The pace of decline is accelerating. When inventory drains gradually, markets adjust calmly. When the slope steepens, urgency grows. Participants begin calculating timelines. They estimate how long available stock might last under current withdrawal rates. At the same time, global pricing discrepancies have opened new pathways. When silver trades at a higher effective price in Asia, particularly through institutions like the Shanghai Gold Exchange, physical metal tends to migrate toward the stronger bid. Arbitrage is not theoretical, it is mechanical. Traders ship metal to where premiums are highest. Once that metal leaves U.S. vaults, it does not automatically return. It becomes embedded in industrial supply chains elsewhere. So the exchange faces pressure from two directions: delivery demand pulling silver out, international arbitrage pulling silver eastward. And there is a third force. Industrial buyers increasingly seek direct supply agreements with producers. Large mining companies such as First Majestic Silver and Hecla Mining have reported realized prices significantly above the average futures benchmark during certain quarters. Those premiums suggest buyers are willing to pay more for guaranteed supply directly from the source. From the perspective of a technology manufacturer or defense contractor, reliability outweighs marginal price differences. A production line that depends on silver cannot afford interruption. If paying a premium ensures uninterrupted supply, it becomes a rational business decision. Every ounce secured through a direct contract is an ounce that bypasses exchange inventory. This creates a subtle but powerful feedback loop. As inventories fall, confidence in exchange availability weakens. As confidence weakens, more participants demand delivery or secure private contracts. As more metal leaves public inventory channels, inventories fall further. Feedback loops in commodity markets can remain dormant for years, but once activated, they accelerate quickly. Historically, exchanges have mechanisms to respond to stress. Margin requirements can be raised to reduce speculative exposure. Position limits can be adjusted. In extreme historical cases, trading rules have even been modified to cool volatility. These measures are intended to preserve orderly markets. However, rule changes cannot create metal. They can influence behavior, but they cannot replenish depleted stockpiles overnight. Meanwhile, government policy discussions have begun emphasizing the strategic importance of critical minerals. Officials have acknowledged that sustainable pricing is necessary to incentivize long-term mining investment. Strategic reserves and structured pricing frameworks have been publicly discussed. That adds another layer of complexity. When policymakers highlight the need for higher or more stable mineral prices, it signals recognition that current pricing may not fully reflect supply-demand realities. So where does that leave the silver market? At a crossroads between paper structure and physical necessity. On one side, the future system continues functioning, matching buyers and sellers of contracts. On the other side, physical inventories are visibly declining, while industrial and investment demand remain firm. If physical tightness persists, price must eventually reconcile the imbalance. That reconciliation could occur gradually, through rising futures prices that attract new supply and slow demand, or it could occur abruptly, through volatility triggered by sudden delivery stress or policy action. But the central narrative remains consistent. Silver has transitioned from being viewed primarily as a financial trade to being recognized once again as a strategic industrial resource. When commodities shift from speculative vehicles back to essential materials, pricing dynamics often reset. The modern silver story is not just about charts and contracts. It is about electrification, technology expansion, geopolitical supply chains, investor psychology, and the limits of financial engineering. Paper markets can expand infinitely. Physical resources cannot. And when the two diverge, history suggests that physical reality eventually leads. Now let's bring everything together. The most important insight is this. The price you see on a futures screen is not always the same as the price required to secure real, guaranteed physical silver. And right now, the gap between those two realities is widening. On exchanges like COMEX, silver trades in standardized contracts. These contracts set the benchmark price that financial media reports every day. But that benchmark only works efficiently when confidence in delivery remains intact and inventories are sufficient to meet demand. When registered warehouse stocks begin falling rapidly while delivery interest rises, the benchmark mechanism starts to strain. Now add another confirmed data point. Major producers, such as First Majestic Silver and Hecla Mining, have reported realized selling prices meaningfully higher than the average futures benchmark during the same period. That matters. If the futures market were perfectly aligned with physical supply, buyers would simply purchase contracts and take delivery at the exchange price. There would be no reason to pay a substantial premium directly to miners. But premiums are being paid, and premiums signal urgency. When industrial consumers, companies that rely on silver for manufacturing electronics, solar infrastructure, medical devices, and defense components, pay above benchmark prices, they are prioritizing certainty over theoretical savings. They are effectively saying, guaranteed access is more valuable than a cheaper contract. This reveals something fundamental. The futures price represents the cost of financial exposure. The realized miner price represents the cost of physical assurance. When those two diverge significantly, the physical market is communicating stress. Now consider the inventory trajectory. Deliverable warehouse stocks have been trending downward for months. The decline is not a one-day anomaly, it is persistent. Meanwhile, unusually high percentages of expiring contracts are standing for delivery instead of rolling forward. That behavioral shift is critical. Futures markets are built on the assumption that most participants will not demand physical settlement. When more traders choose delivery, the exchange must draw from registered stocks. If withdrawals consistently outpace inflows, inventories shrink toward uncomfortable levels. At that point, the exchange has limited tools: raise margin requirements to reduce speculative positions, encourage cash settlement rather than physical delivery, adjust position limits, rely on higher prices to attract metal back into vaults. But none of these tools create new silver. They influence participation, not geology. At the same time, policymakers have publicly emphasized the strategic importance of critical minerals. Discussions around pricing stability and long-term investment incentives indicate that governments recognize structural supply constraints. When officials speak about sustainable pricing as a key to unlocking mining investment, it implies that current pricing may not be sufficient to balance future supply and demand. Put simply, multiple forces are pointing in the same direction. Physical inventories are tightening. Industrial buyers are willing to pay premiums. Delivery behavior is shifting. Policy conversations are acknowledging supply stress. Markets eventually reconcile imbalances through price. If physical supply remains tight, futures pricing must adjust upward to attract new supply, discourage excessive demand, or both. That adjustment may not happen smoothly. Volatility is often the bridge between imbalance and equilibrium. The reveal here is not that silver is running out tomorrow. The reveal is that the physical market is already behaving as if silver is more valuable than the paper benchmark suggests. And when physical reality and paper pricing diverge, history shows one consistent pattern. Paper eventually follows physical, not the other way around. Now, I want to hear your perspective. Do you believe futures exchanges can smoothly manage this tightening cycle? Or do you think physical premiums will continue expanding? If you were an industrial manufacturer dependent on silver, would you rely on exchange contracts or negotiate directly with miners at a premium for certainty? There is no single correct answer. Markets are complex, they evolve. But informed discussion matters. Drop your view below. Will inventories stabilize soon? Will futures prices rise to match realized miner prices? Or will structural shortages deepen? And if you found this breakdown useful, share it with someone who follows commodity markets. The more people understand how physical supply chains interact with financial pricing systems, the clearer these trends become. Stay analytical, stay objective. The numbers matter more than headlines. Now let's return to where we began. A major pricing exchange, shrinking deliverable inventory, rising delivery demand, premiums paid outside the system. The math is simple, but the implications are powerful. If inventories continue declining at recent rates, pressure builds. If buyers continue paying premiums, the paper benchmark must eventually respond. If policymakers continue emphasizing strategic pricing, supply dynamics shift further. You cannot manufacture silver with financial engineering. You cannot replenish vaults with confidence alone. Markets ultimately converge toward physical reality. Whether that convergence comes through gradual repricing or sudden volatility remains to be seen, but the trajectory is visible. And when multiple signals align, inventory, earnings, policy, premiums, it is worth paying attention. The silver market may be entering a new phase, one where physical availability leads price discovery instead of following it. Watch the data, track the vault numbers, monitor realized miner prices, because when paper and physical disconnect, history shows the gap never stays open forever.